Welcome to Idea to IPO. Hello, I'm Jennifer Stowell. Idea to IPO has been hosting tech startup events in Silicon Valley for many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have produced over 150,000 events members. We have over 150,000 members among all of our meetup groups all across the world. We have organized, promoted, and produced over 2,719 events. By any standard, by any measure, we are the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at idea2ipo.com. Our featured speaker today is Jason Putnam Gordon. He is one of the top venture capital attorneys in Silicon Valley, and he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Jason Putnam Gordon. Jason, take it away.
Good evening, Jennifer. Thank you very much for being here, and thank you very much, Idea to IPO. I'm Jason Putnam Gordon. I'm a venture capital and emerging growth company attorney with Polsinelli, and today we're going to talk about how to do a venture capital financing. I'm very excited. Before we get underway, let me provide you with a few pieces of information. First of all, I'm running the tech in the background, so a couple notes on that. One, this is being recorded. So good news is if you've registered, if you've missed some or all of it, we'll send that recording to you. Bad news is everything is recorded. So please don't share any confidential information. It will be memorialized for posterity. Additionally, one other note that I have is that if you've got a question, that's terrific. Please use the Q&A function for your questions so that we can address them kind of in order. I've got a billion different screens up, and I'll be monitoring the Q&A. The chat is really for you to communicate with the other folks who are in the room today. Additionally, as you may have seen, we've got an audience survey in progress. So please feel free to fill out that survey. It helps give me a sense for who's in the room today. And I'll be looking at that, and we'll share the results in a little bit. So without any further ado, let's jump into things. During today's conversation, I'll speak for about an hour, and then we'll take about a half hour of questions. If you've got a question, use the Q&A function. I'm going to try and answer some of them every few minutes before we transition topics. So we would not, you wouldn't be hearing a talk from a lawyer if you didn't get a number of caveats, right? So today's discussion is general information. It's not legal advice. That's true even if we talk about whatever your situation is today, or even if we have a conversation after today's event where you share with me some facts. Probably it's not going to be all the facts, because if we just have a 15 or 20 minute or 30-minute conversation, which I typically have office hours and like to do to support the community, I'm not interested in getting confidential information, and it's not appropriate for me to give you specific legal advice. If we were to engage and work later, that's a different story. So let me give you a little bit of an overview of how today's conversation is going to go. First, I'm going to share with you a little bit about my background. I'm also going to let you know who else is in the room. We're then going to move on to the venture model, okay? Because I think in order to really successfully run a venture capital financing, you need to understand what moves and drives VCs. We'll also talk about the term sheet negotiation, which is a critical step in the path to raising financing. We'll talk about deal documentation that's going to follow the term sheet, and we'll talk about diligence, and then closing and post-closing items. And then I've got sort of a hit list on the end if we've got some extra time. Plus, we'll be working in your questions today. So it's going to be a fun, exciting evening. I say evening because I'm here in the Bay Area, San Francisco Bay Area, and the sun is setting, and we're just getting started. All right. So I guess we've got just taking a real quick look at some of these other questions. Yes, question as to whether or not folks are on mute. Yes, you're on mute. Please use the Q&A function. All right. Let's move on. All right, so my background. I'm a venture capital and emerging growth company attorney. I've been practicing since 2005. I'm with Polsinelli. It's an Am Law 100 firm. We've got roughly 900 attorneys and over 20 offices throughout the US. My office is in San Francisco, although I work with companies, not just in the Bay Area, elsewhere in the US. And then because the Bay Area is an international hub for startup and venture, I work with companies from all over the world who are doing business here in the Bay Area. I love working with startups and emerging growth companies. I have a passion for entrepreneurship. Before I ended up back at a big firm, I ran my own firm for a while. I really enjoy that. And I also love being outside general counsel. And today's conversation, I think, is going to be most beneficial. Let's talk about who this is going to benefit the most today. I think, if you are on the eve of raising venture capital, right? So maybe you've done some seed financing before in the form of convertible notes or safes. Yeah, this is probably a sweet spot for you. But I think if you are, elsewhere in the life cycle, from either thinking about forming a company that you intend to be venture backed, or, you formed one and you're thinking about raising your first seed capital, maybe via safe or a convertible note, today's conversation is going to be informative for you. And it's going to help you get a sense for, what's the path that lies ahead for my company if it's successful? And, what is it that I need to do in order to continue down that path and be successful? So let's first talk about an overview of the venture capital model. I've basically tried to distill it into three bullet points, right? So how do VCs, that is traditional VCs, that is financial investors, right? What are they doing? What motivates them? Well, their goal is to give returns. And the reason why they need to get returns is because they have investors, right? There's a venture capital fund. That means people are putting money into the fund. Those people could be individuals. They could be sovereign wealth funds. They could be pension funds. They could be family offices. Those are the LPs in a venture fund. Those limited partners, those LPs, are putting money into the fund to get a return. And, their return is usually they're looking sort of for 3x their money over the life of a fund, okay, which is 7 to 10 years plus or minus. So what a VC does is they try to identify companies to make investments in. And they usually have a thesis. They kind of focus in an area or two, and they focus maybe in one part of the life cycle, although not always. And, they're looking for companies that are going to have like a home run, where the returns will be 10, 20, 100x, depending upon what stage of life the company is in. And they acknowledge and they know that in their portfolio, there will be a number of losers, quite a number of companies that are just not profitable and they lose their money. There will be some singles where they'll get their money back, or maybe 2x their money back, or something along those lines. But it's really those winners that drive the value of the portfolio, get the returns that the VCs need for their LPs to make them happy. Now, strategic investors are playing more and more in this space. I mean, in the last 5 years, it has just, the last 10 years, but especially in the last 5, I feel like it's just gone up substantially. And maybe later we can have a conversation about some of the impact of that. But suffice it to say, their model is typically a little bit different, and it's a little bit more individualized for whatever their situation is. But, just to give you a sense for some of the things that strategics are interested in, it could be, they've got a product that they want to incorporate into other people's products. So they want to expand their market base, right? And sort of, Intel might be an example of that, with being a chip manufacturer, and they want to put chips in everything. It could be that they've got, they're an innovative company and they need to stock their innovations pipeline. And so they're looking basically to fund companies to handle the innovation aspect, and then they buy them up. So that's like corp dev. All kinds of different considerations, financial is in there, but you just understand they come to the table with a slightly different lens than a traditional VC does. And, there's some thought that needs to go into when you're working with a traditional VC, you're working with a strategic investor. What is it that they're looking for? What is it that's going to make them happy? Not happy, but what is it that's going to get their motor running? Now, continuing on with this venture model, sort of the goal is, at least from the legal aspect, is you tie all of the relationships into the company. You tie the capital, right? You memorialize the influx of capital. Those are your investors. You tie the intangible assets and ideas into the company, right? Through IP assignment agreements and other things like that. And then you tie the relationships of the employees and the other technicians so that when you put these things in the company, you give it some time with the right people, it starts going out there, it's got product, doing sales, starts growing in value. And the ideal model kind of looks something like this, where in the seed and angel stage, there is, not only sort of negative revenue, right? But not only that tremendous cash burn, but there are a lot of companies that don't make it. The vast majority of companies don't make it. And in that stage, what's happening is the initial team is coming together and the prototypes are being built. And then you start to go to market. And kind of at that point, once you got into the market, and if you're showing some traction and you're showing that really what the rate limiter to growth is just not having enough money to spend on getting the right sales team in, to spend in increasing your ability to produce, to spend, that's what makes the VCs happy. And that's what, that's sort of the story that they look for to, to feel comfortable making those investments. Now, you'll also sort of notice, and I kind of put this side by side, that, and you think about the amount or the percentage of the company that the founders own versus the investors and how that changes over time as you move through these different rounds of financings, right? Where you see the Series A, B, and C on the left, and then you also see on the right, you see initially the founders own all the company, then they take a haircut, then they take another haircut, then they take another haircut. But in the meantime, the value of their stake is going up dramatically. So even though, on a percentage basis, they have less of the company, that smaller slice of the company is worth tremendously more. I'm going to take a look just at my notes here and then also take a look at some of these questions real quick. All right, questions. I'm going to try to answer questions that have broad applicability. Okay. Smith. Hopefully I've answered what VCs are looking for when it comes to Series A raises, and you have to also understand that the nomenclature, whether it's a Series Seed, Series A, a little bit mushy. And sort of two things on that. What we're talking about here when we're talking about Series Seed or Series A is we're talking about a preferred equity raise where there's a price round. That is, there's a value of the company. So the VCs negotiate a value of the company for sale of preferred stock. And we'll talk about this preferred stock and the bells and whistles that it has. But again, sort of usually speaking, absent sort of being in the life sciences space, which I play in, usually they're looking for demonstrated appetite in the market and a team that can execute. That's what I'd sum it up as. We've got sort of a lot of chat-like things in the Q&A. Please don't do that. Please just use the chat for chat. And if you've got a question you want to ask me, let me know. And there was a question about any denotations or markers for seed versus Series A or versus Series B. Well, usually A, B, C, etc. is just in a chronological order, right? So A comes before B, comes before C. In terms of the amount of the raise, it's smushy. I mean, there are some, and sometimes that's also where the Series A comes in. Series Seed comes in. Sometimes, what would have historically been a Series A, if you'd raised $5 million, is now called a Series C seed. It's really sort of almost for branding purposes. People want to signal to the market, I'm doing a huge Series A, which is really kind of what would have been a Series B 10 years ago. They're signaling this to market to show just kind of how strong they are. All right. So moving on, I see there are some more questions. We'll answer a little bit later. So what makes a good investor and how to find them? So I think if you are on the company side, what you want to be thinking about is finding investors that are quote unquote the smart money. So smart money means they understand your space. They may have played in it before. They have connections. So, they have connections to other VCs that are interested in that space, other investors that are interested in that space. They've got relationships with suppliers and vendors, potentially. They've got maybe access and relationships to customers. That lots of times that's sort of where strategics sort of try to showcase their value, if you will. But from the company's objective, you don't just want money in the door. I mean, you may need money. The company may need money in order to grow. But, ideally, you're looking for an X factor, especially with like a lead investor. And in particular, you want to make sure that you've got money that understands your space so that when those setbacks and challenges come, and they will come, you understand, and the investor understands to be patient and can also hopefully help you navigate them. You want investors that are supportive of the company, not necessarily supportive of the company over the long term in a holistic sense, not necessarily concerned about just getting their money out as quickly as possible. So let's talk about some pre-round issues that come up quite frequently. So what you're going to want to make sure that you have is the correct corporate structure in place. So typically VCs are going to insist on a Delaware C Corp. There's a reason for that. Delaware usually has the most protected, usually has the best protections for the directors and officers. VCs are going to want to put a director on the board. So they want to have sort of maximal protection with respect to their liability for their director and his or her decisions. Additionally, Delaware corporate law Delaware is focused on corporate law. And so Delaware also really has sort of the best infrastructure for that. Additionally, and related to that, there's the Delaware Chancery, which is a sophisticated court that's devoted to business issues. So if you've had, if there's some sort of issue that comes up with your company, and especially the corporate governance, probably some other company had that issue, there's some precedent on point, it can help shortcut a lot of uncertainty with respect to who's got what rights and the effect of that. So thirdly, Delaware's got a great Secretary of State's office. They process paperwork really quickly, which is important if you're trying to get financings and mergers and acquisitions done. Now, additionally, you're going to want to make sure that you've got company documentation in place. So what does that look like? What does that mean? Well, we kind of talked a little bit about this earlier. You want to make sure you've got the right IP assignments. That means all of the IP that's getting generated that's related to the, to the business, and especially the key aspects of the business, needs to go into the company. You need to make sure that you've got vesting in place, especially for those founders. So vesting is about if a founder leaves, that founder doesn't take all of his, her, stock with them. Now, vesting, we can talk a little bit about this more, but people sort of think of vesting as, all right, I got 4 years, 1 year cliff. Cliff means, okay, there's a year before I get any of my stock. 4 years means by the end of 4 years, I've gotten all of it. It's a little bit of a misnomer because vesting isn't about sort of giving you shares as time goes by, so much as giving you, the founder purchasing all of their shares right today with strings attached to them. And then as time goes by, strings get cut so that if that founder were to leave, the founder only takes the shares on which the strings have been cut. And there are 83B elections, which are important tax issue, which we can maybe talk about later. And those need to make sure they get filed. There are other issues that are important to have in place in terms of corporate documentation. These pertain to rights of first refusal on sales of stock, right? Making sure you can control who's on the cap table and your co-founder can't sell all of his or her shares to your competitor. Those types of things are pretty important, as well as other restrictions in the bylaws, so that you can't, again, just willy-nilly sell your shares. Now, thinking a little bit about the path, the progress of a company, right? And you go back to that timeline, which I showed earlier. In that sort of seed stage, typically you're going to be doing convertible notes or safes to raise those funds. Not always, but typically. You typically stay away from common stock because common stock has, if you start selling common stock, you're going to set the value of that common stock. If you want to issue equity to your employees, if you've already sort of established what the value of the common stock is and, in an arm's length negotiation with an investor, those employees are probably going to have to pay that price for that common stock, or their options, or the option exercise price is going to be the same as what that investor paid. And that's probably a lot more than you want to or want to have to do. Let me just see here. Let me just touch a little bit more on safes and convertible notes. So again, going back to this theme, you don't normally sell common stock because of the issue of setting the value of the common, or for that matter, setting the value of the company. That's one reason why safes and convertible notes are used. And I have a whole nother presentation, and if you want to email me or connect with me on LinkedIn, if you want to see it, we could show you the video. I know Idea to IPO also has a bunch of my past videos, so you can find it on there. But the safes and the convertible notes, which don't use without getting the advice and guidance of a lawyer, but the safes and convertible notes, one of the nice things is that they delay when you have to actually value the company, so that this issue of either undervaluing the company and selling too much of it too early, or overvaluing the company. So one, either investors aren't willing to invest, or two, they sort of effectively have a down round afterwards or something along those lines. All that gets avoided. And that's why it's very popular. It's really a mechanism to prepay to get shares of preferred stock at the preferred round at a discount, effectively at a discount. So two pieces. One, just to revisit really quickly, another reason Delaware C Corp. Talked about why Delaware, didn't talk about C Corp. It's typically a C Corp because funds, venture funds, are set up as limited partnerships. Those are pass-through entities. So when they are investing in all the startup companies, if the startup were an LLC and that LLC didn't have an election as a C Corp, if the LLC were, if it were just a pass-through LLC, then all of those losses, or to the extent once the company becomes profitable, all those profits would get attributed up to the fund and then up to the investors, and it would be a tax and accounting nightmare. Now, moving on to that third bullet point, round modeling. When I say that, that means before you even go out and start negotiating a term sheet or start floating ideas for what you want your term sheet to be, with investors that you talk to, you're going to want to do some pro forma cap table modeling to understand what the cap table is going to look like, not just at the end of this round, but also the end of the next round. And when I say, what does the cap table look like? I mean, on a fully diluted basis, which is also sort of one of those squishy terms that you would think has a very precise definition, but really you always need to read the documentation on it. But for on a fully diluted basis, which generally sort of means all common stock and anything that is convertible into common stock, either directly or, via conversion into something else that is convertible into common stock, what that basis is. So what are some things that are convertible into common stock? Preferred stock, convertible notes and safes are kind of indirectly convertible into it, because first they would change into preferred stock and then they would change into common. Warrants, options, things of that nature. You want to understand what, as a founder, what your percentage is on a fully diluted basis. After that, after taking into account the employee option pool, which you'll presumably want to get into place. So you really have a sense for how much of the company you have after that round. And then thinking ahead, right? If we think about that, that model that I showed you earlier, that graph, right? Presumably you're doing more than one round of financing, right? It's not just an A or a B. You're probably gonna, if it's gonna be successful, it's gonna be A, B, C. Maybe you'll do a D. Maybe you'll do an E or an F or a double E. Before you would have a successful exit, which is, sort of typically categorized as an IPO or a great M&A exit. And somebody asked a question, and maybe now's the time to sort of ask or begin to answer it. But somebody's asking about debt in the process. So there's convertible debt, which has an interest rate, has a maturity date. That's the date you got to pay it back. And then other than that, there's kind of a general sense as to what is in these things, but you got to read the fine print on all of them, because there's not really a standardized set of terms. That is really used as a mechanism to get some early money in the door, along with a safe, which doesn't have a maturity date and doesn't have an interest rate. But that's sort of different than venture debt. And venture debt is usually after the company has, after it really has done a venture round or two, it's got some real revenue, probably profitable. And that's sometimes also called non-dilutive financing. So kind of as you're looking at that growth curve and you see, the company edging up closer and closer to an IPO or some sort of other exit, if the company and the investors of the company want to get some leverage, that is, get some extra capital in the door with hopefully very little dilution, right? Because if you do another round of financing, you're going to take a bunch of dilution. That's where that's where the venture debt plays. So that's really kind of beyond the scope of today's conversation, but somebody asked about it. Okay. Got some nice, I'm going to take a look at some of these questions now, and because we're going to transition on to the next sort of related topic. I've got some good thumbs up on some stuff. Okay, common question about convertible notes and safes and caps, and asking whether or not a cap is a valuation in disguise. So let me unpack that a little bit. So by and large, the two main mechanics in either a convertible note or a safe are either the discount and or the cap. So discount, and again, I don't want to get too deep on today's conversation, but discount basically says, if there's a 20% discount, if the VC at the price round is paying $1 a share, the safe holder is going to get their substantially equivalent share for 80 cents. 80, basically you look at what the principal amount of the safe was, and that'll get applied on an 80 cents. So you divide the principal amount by that price, that 80 cents, and that's the number of shares that they'll get. Cap is a little bit different mechanism. It effectively can supercharge the discount. So the cap basically says, well, we don't care what the valuation of the company is at the price round. We're going to view it as whatever that negotiated cap is, right? So in the price round, the valuation could be $20 million, but the cap could be 8 million. So you're looking solely at the cap for the valuation of the company. And so some people say, well, isn't that really just a valuation in disguise? I say when you're company side, I think really what the goal or the objective of the cap is to provide an extra sweetener so that if those early investors, the capital they put in allows you to really get a lot of growth and really grow a lot of value. Well, they took a lot of risk and they should get a lot of upside. So effectively it acts as like a supercharged discount. So instead of a 20% discount, it might be 30 or 40 or 50. I think that's really sort of the better way to look at it, is that it's a mechanism to allow a much larger discount if you are able to really get a lot of growth out of that first money in the door. And I think that's also particularly true because I think when you're looking at that lens, what you're trying to do is you're trying to figure out, okay, the cap should really get set at what you think the valuation is going to be at that price round. So that, again, if it turns out the company really grows a lot more with that capital and you get a much larger valuation, you're getting the investors are getting some upside on that. I've got a whole presentation on caps and convertible notes and safes. So we'll just leave that as a preview. All right, answered that. Is a founder's agreement in the documentation? Would a VC see that? So usually when the founders, so the standard way for founders to get stock or when you're doing a setup is certificate of incorporation, get the initial board appointed, restricted stock purchase agreements for the founders. So they buy their stock, they sign an agreement that has that vesting, which we talked about. Additionally, the founders assign the IP into the company, either in the RSPA or separately on. And then, there's also a proprietary information and inventions assignment agreement that the founders sign, so that moving forward, any IP that gets generated gets up and into the company. And a VC does see all of that and they check for all that in the diligence process. Somebody asked about startup studios, which applies to our strategy. They said the structure is different. I'm not sure. Maybe you can ask a longer, like a more detailed question. If it seems like it'll have general applicability, I'll try and answer it at the end. Okay, here's the question on debt financing and venture financing. So I think this person is also asking about some other things that are out there in the landscape, like what was it? I can't remember what they're called at this point. It'll come to me when I'm not trying to think about it. but there are some mechanisms out there that allow you to leverage, right? I mean, you could also get a line of credit. You could also do factoring. There are some startups that basically allow you to take receivables. There are some companies out there that allow you to take receivables and sort of borrow against them. There's some startups that do that. They call it something other than factoring, but kind of at the end of the day, it's pretty similar to factoring. Those things can work and can allow you to supercharge the growth. One of the issues with debt is you can get over leveraged, and if you can't pay it, they could force you into bankruptcy. And that's different than equity. So, again, getting a little extra juice out of debt can be a good strategy, but you'll need to be careful about it. And then there are also I've seen some other deals out there that basically kind of function with debt as debt, but you pay it off as a percentage of your revenue. Otherwise, it sort of flips over in convertible notes. There's one fund, and I don't remember their name at the moment, that was doing that, but then they folded up this year, or they closed. Maybe that's a better way to put it. I don't know if they folded, but they closed. I have not seen a lot of traction there. I think it may depend very specifically on what your business is, right? And I mean, that might work well in some businesses, but not others. How far should you bootstrap to give yourself enough leverage to avoid one-sided terms at the early stage companies that take it? Look, I hope I've been able to convey that sort of one of the primary directives of the VCs are, the traditional VCs are, look for those winners so they can get the return in that time frame, right? 7 years plus or minus a few, for their investors. And what they're focused on are finding companies with great founders and execution that can take advantage of the market and scale, and that have sort of demonstrated that all they need to do is inject capital and some, maybe some additional help, and boom, the thing's going to take off like a rocket ship. So if you can bootstrap for quite some time and sort of shortcut the initial seed raises and other things, then you also potentially have a really good story to tell in terms of why, if they inject their capital, you'll be able to get a lot of bang for the buck out of that. Pros and cons of convertible note versus safe. Generally speaking, if I think safes are a little bit, you need to run the models, and there are some tweaks that probably should happen in those safes, but usually speaking, safes are better for the company than convertible notes because safes don't have a maturity date and you don't pay interest. Does an LLC or C Corp affect the investment? I think I answered that, which is VCs need to invest in C Corps. All right. Can an early stage startup acquire indemnity insurance to protect VC against loss? Not that I'm aware of. I'm not sure exactly what that question is getting at, but not that I'm aware of. Okay. Great. We've got a lot of questions, and I'm going to keep chugging along because we've got some of the best, most important stuff, right? So all of this is sort of leading up to the VC round, right? So you've got the right entity in place. You've got that seed financing, or you've been able to bootstrap, and you've been able to grow off the revenue that you've got. That's great. You've done your round modeling, so you know how much of the company you want to sell. You've done your diligence. Okay. You've identified some VCs. You've got your funnel of potential investors. You're moving them through the pipeline. Let's talk about how you get that funnel a little bit. So one of the nice things about being here in the 2020s is that there's a lot of information about investors online. So you can find this information in places like Crunchbase or PitchBook, and you can find, pretty much where most VCs invest their capital. So, typically don't recommend that you reach out and contact a VC and try and pitch a VC that's investing in your competitor. But if you see that they're in their space, might be a good target, to get connected to, right? To try and get a warm introduction through a trusted referral source from them. Not only should you kind of be looking at funds that are in that space, but if you can even drill down a little bit further and figure out which partner at that VC fund specializes in whatever it is that you're doing, you're probably going to get the best shot at, getting a good outcome in terms of going in for that pitch, right? Because then they'll understand their space, right? One of the things about hopefully, working with smart money is when you go in and you explain your idea to them, they get it and they get why it's going to make money. If you have to do a lot of foundational, if you got to lay a lot of foundation so they understand it and they understand the market, well, one, it could be any number of things, right? But typically it's one, they're just don't familiar with the space. It's going to be too much education and probably not going to be interested in it. Or two, you may may not have a good idea. Sussing out or an idea that they think is investable is maybe a better way to put it. Only time will tell, and kind of getting out there and pitching it a few times are the way that you're going to be able to do that. Now, let's move to the term sheet. So you've kind of done all of this, right? And you've had some conversations with them. You've kind of let them know how much of the company you're thinking of selling, sort of typically 20% plus or minus 5 to 10, could be up or down from there. What the valuation is going to be. Then it's term sheet negotiation. So typically VCs will deliver a term sheet to the company if they're interested in making an investment, and you negotiate off of that term sheet. Sometimes if a company is super hot, then you can basically kind of put together your own draft term sheet and go out and shop it. Now let's talk about what terms are in there. So first and foremost, how much of the company is being sold and what's the valuation? We kind of talked about that. And I think it's also just worth pointing out that if you're raising off of convertible notes, if you're raising off of safes, if for some reason you're raising off of common stock, at the end of the day, it's a piece of the company that's getting sold. It's a sale. So just keep that in mind. That's that's primarily the biggest term, usually. Some of the other terms you'll see in there are dividends. So that is, if and when the company declares dividends, what percentage that's going to be based off of the issue price of the VC stock. Liquidation preferences, that is if the company, exits or folds, who gets paid in what order, right? So one thing to keep in mind is creditors, that is people who have lent money to the VC, lent money to the company, or otherwise the company owes them money, you will get paid before the equity. Okay, equity is common and preferred. And then in the order of preference of the equity, it's preferred and then the common. And then within preferred, it's sometimes negotiable as to who's getting paid first between the A, B, et cetera, et cetera. And those liquidation preferences can make a big difference. So many times it's sort of 1x. So basically, the greater of 1x or as converted into common, right? And in that case, it's whatever the VC will get more of, either the money that they put in, they get back, or if they convert it over into common, what a common shareholder would get paid on a per share basis. And then there's all sorts of other blends. It could be 2x, it could be participating, so that if, first they get their money back, but then they also participate as a common holder, all that. Voting rights, what governs voting and other protections. And same thing with the protected provision. These are, business terms and other things like changes to the certificate of incorporation, or having a subsidiary that's owned by both the company and somebody else that the preferred would get to vote on. Let's see. Some conversion provisions, registration rights that deals with the ability of the preferred to be able to either force an IPO or other registration to sell their shares and liquidate. Anti-dilution protection is very common. I mean, if you're doing a Series C deal on Series C docs, it's not in there, but it's almost always in deals these days. And that just is, if there's a down round, the VC gets topped up basically in terms of the equivalent number of shares that they've got. Making sure vesting is in place for founders, kind of going through the documentation, who's going to be preparing the documents. West Coast deals, usually it's the company that prepares them. East Coast deals, sometimes it's the investor. Attorney's fees. So in a price round, the company not only covers its fees, but frequently also covers the fees of the investors, or at least a negotiated amount of fees of the investors. And no shop and confidentiality provisions, They don't want you to take that term sheet out and shop it with somebody else. And whether or not investors get a board seat or multiple board seats, all in the mix. So that's what's in a term sheet. That term sheet basically sort of sets up what's going to be in the set of financing documents, which we'll talk about in a minute. But before we do, I want to share the audience survey results because I got kind of underway and just got caught up in the moment. So it looks like we've got over a third of the people from Bay Area, which is great. A few folks from elsewhere in the US, excuse me, almost a third from elsewhere in the US. Got some folks from Europe and Asia, some folks in Africa, some folks in Australia, and some folks who are somewhere else. We've got an overwhelming number of people who are in early stage startups. We've got some folks in growth stage. So that's kind of typically after the A, maybe in the B stage. And we've got some angel investors. Some folks in academia and some students. And then we've got some folks who do other things. And so one other comment is, I mean, not only is it the people in the room today, but also this is recorded and we'll distribute it afterwards. All right, let's see if we can answer some questions and keep this thing also moving along because we've got a couple more pretty critical slides. Here, let's see. I'm seeing a number of great questions, which I think I'm going to just defer to the end because right now I'm thinking about trying to hit stuff that's cap table, term sheet focused. Your sample chart has 20% allocated to new investors in most rounds. Is this the typical amount to new investors? Is it typical? So typical is kind of within the realm of normal. I mean, I think I said it earlier, typical sort of like 20% plus or minus 5 to 10%. And that's usually on a post-money basis, not a pre-money basis. So option, stock option pool bumps and stuff usually gets included in the pre-money. So it doesn't come out of the post, so in other words, the investor wants to get 20% of the company. They're getting 20% of the company after the option pool has been bumped up. For preferred stock, is a PPM used for the paperwork? No, not typically. If you're raising from venture investors, especially funds. Oh, good. I answered somebody's question. Sorry, we've got a lot of really great questions. Oh, how can you tell if it's reasonable to approach a VC or you still need to work with angels? Great question. So when we're thinking about this and you think back to my chart, again, things are a little bit fuzzy, right? So usually if you're raising from angels, you're raising a few $100K. Maybe if you've got a super angel that is like really like a really wealthy angel that's interested in the space, it could be several $100K or $1 million plus, or there are even sort of bands of angels. So maybe it'd be $1 million or $2 million. There are some VCs that have basically like, they're called micro VCs, right? So they actually play really in the early stage space. But typically, if you're really doing a preferred price rounds, you're looking at, especially in the Bay Area, probably around the size of at least 3 million, probably more likely 5 million or so or greater. In terms of when to approach VCs or not, I think one of the things is in this space, you want to build trust. So VCs are people. You want to build a trust and a relationship with them early before you want to raise capital from them. So I don't think there's anything wrong with sort of trying to get your list early, trying to get intros early, trying to have conversations or end up in rooms with them or network with them, before you need to make an ask for the raise, and kind of hopefully in the course of that conversation or dialogue, you get a sense for, you've targeted in, like we're at the stage in which they invest or not. And you can also tease out a lot of that information, either PitchBook, Crunchbase, the VC sites will sometimes tell you what exactly they are looking at. So hopefully that answers your question. Is it true nowadays that VCs are into a return on their investment more than 10x? So I think it depends on what stage they're investing in. If they're investing in like a D stage, then going to go out to IPO, probably not, right? Because there's only so more rounds. But the sort of ideal traditional winner looks like a company that sort of doubles or triples in value every 18 to 24 months or so, right? So if a VC were to make $1 million investment in a Series seed round, that investment would be worth $3 million at the A. At the B, it'd be worth $9 million. At the C, it'd be worth $27 million. At the D, it'd be worth $81 million, et cetera, et cetera. So it does sound kind of crazy in one sense to say 10x, but really that's the model. That's what they're looking for. And again, that's also one reason why, if you're sort of taking that 2 to 3x return per round or value at each stage, that's why, the ones that are coming in stage D later, there's just not that much more time before it can kind of double or triple before they exit. And it's largely said that the companies have sort of been de-risked by that point, right? Because, they've already had tremendous sales in the market. Hopefully that answers the question. All right, I'm just gonna. Is there a typical percentage where a VC should get a board seat, just an observer seat, or none at all? So if you dilute 10%, they should get a seat. I think it depends in part on just how much money they're putting into the company, as to whether or not it's appropriate for them to get a seat. I think you also need to think about what is it that they're going to add in the boardroom, right? Are they going to add connections? Do they have operation? Is the partner who they're going to put in the boardroom have operational experience who will be helpful? You could do a $5 million. I've had clients who've done $5 million Series seed rounds with marquee VCs, and those VCs have not taken board seats. So you don't necessarily have to give one up, but you should make sure that, if you are, it's being used strategically, because it's hard to take them back afterwards, if you will. Another note on observer seats, I would not give those things away willy-nilly, because again, founders, board members, VCs are people. And so who's in the room and part of a conversation affects the outcome of that discussion, or it affects that discussion. Similarly, if your company side, you need to think through what it's like to have a strategic in your boardroom, whether or not there is going to be some issues of confidentiality, maybe some conflicts of interest between your business and their business, and how to solve for those situations where everyone can really get what they need, right? They can get their information without it sort of jeopardizing the company's commercial success. All right. Clicking back into it, deal documentation, sort of the nuts and bolts and bane of my life some days. So to do a venture round, it's typically, okay, so if you go to nvca.org, I believe it's org.com, not .com, there's a very standard set that most venture capital attorneys work off of these days. I wouldn't have said that 5 years ago, but I'd say it these days. And, in that set, The sort of main financing documents are the stock purchase agreement, the amended and restated certificate of incorporation, the investors' rights agreement, the voting agreement, and the right of first refusal and co-sale agreement. And you take all the terms from this term sheet, and they're all kind of interwoven throughout this suite of documents. And you alter them sort of accordingly, and then there may be some other terms that get negotiated, and you put it in there. And there's another set of documents that also gets done, ancillary documents, which include the board and stockholders' consents, various waivers if in case any existing investors have preemptive rights, maybe side letters, and we can talk about side letters a little bit later if we've got more time. But I'm running a little bit long on this. Side letters are agreements that are outside of the main set of agreements that give rights, maybe an observer seat, maybe preemptive rights, maybe some information rights, something along those lines. The investors are going to want to have a pro forma cap table of what it looks like on the close, and potentially you may need to have a legal opinion done as to the capitalization of your company. Usually not in the early stage. You don't necessarily want to have to spend the money on it. It's expensive. And so it's not super standard. And then there's frequently a bunch of cleanup that needs to get done. Clean up corporate documents or clean up commercial documents or employment documents. Everybody understands that startups are cash strapped, and so nobody's expecting perfect documentation. What they're doing is they're looking through your documentation to see what you've got and see what needs to get cleaned up so they can get comfortable that when they're investing in your company, they're not investing in a lawsuit. And that leads us directly over to the diligence process, which is really the process by which the investors take a look under the hood to see, yes, that Corvette actually has a Corvette engine, or ooh, somebody actually kind of ripped it out, or it's got, a Chevy Nova engine in there instead. And that diligence process usually works sort of this way. The investors will typically request the information. You will open up a data room in Box or Dropbox, or if you're, your law firm may have, we have this too, their own proprietary virtual data room, where the investors will see all of the documentation that you've got, all the IP agreements, all the commercial agreements, all your, your leases, any lawsuit stuff, the restricted stock purchase agreements, your board consents, your stockholder consents, your insurance policies, et cetera, et cetera, et cetera. Oh, there we go. I kind of laid it out there. Sorry, it's right behind my camera. And so I couldn't see the whole slide. And then, so what does that look like? Well, there's usually 2, maybe 3 rounds on the financing documents back and forth between investors counsel and your counsel. Some pro tips there, typically there's more than one investor in a round. So you need to be cognizant of what the other investors want to see when they want to see it, whether it's on the diligence side or if it's on the, it's on the financing document side, how much input they're going to have. You're going to want to also sort of coordinate, ideally, so that the investors are sort of sending you an integrated set of documents so that your attorney is not having to negotiate each document twice with a different set of counsel. Or it's actually kind of more than twice, right? Because they negotiate with one set of investors, negotiate with the other. Those guys don't necessarily see eye to eye. So then you got to also kind of mediate. That really drives up legal fees. And when that gets done, the diligence is done, the cleanup is done, then you're ready to close. And typically there's going to be a board consent, a stockholder consent, so you can file that restated charter, which brings to life the preferred stock that, with its preferences, that is its rights that you've negotiated. And then, all the docs get signed, all the signatures get held in escrow, which basically means everyone's got everybody else's thing, but nobody releases them until, everybody says it's okay. And that's usually also dependent on when the money comes in. And then there's usually some post-closing items, which, sort of surround things like securities filings, right? So one of the things, and somebody asked about a PPM earlier, that's important if you're working on a SAFE or convertible note or preferred round, is complying with all laws, but sort of especially securities laws is one of them, right? Because selling that preferred stock is selling a security. So either you need to make sure you've got the right securities exemption in place, or you've got to register that with the SEC, which is prohibitively expensive. So no one does that. And then there are some other notices that go out. You got to issue the stock certificates, and then usually the legal counsel puts together a closing binder, which is all of the documents necessary, or all the documents that are in the financing fully signed. There are a bunch of other issues which come up, including CFIUS and some other things like that, which I'm happy to chat about. But I said I would speak for about an hour and then answer questions. So I've answered some questions, but an hour is up, and maybe we'll do that. And then I've got some bonus questions and comments if you've got them. So if you also bear with me 1 second, I was sick last week, so I'm going to get a cough drop. I'll be right back. All right, thank you very much. I apologize for that, but my throat is running out of stamina. So question about whether or not we'll share the presentation for further study. Yes, so if you've attended and registered, we'll follow up with the video and the presentation. Can founders get preferred shares for capital contribution? Yes, it's technically possible. In the early 2010s, there was a movement to give them founders preferred, which was sort of invented by Founders Fund. The idea there was going to be a mechanism that would allow them to sell that, like the founders preferred would convert into preferred, which the founders could then sell to the investors, so the founders could get some extra liquidity. Kind of didn't really take off. So we don't really see that, although it is technically possible. The web is flooded with VC and angel groups where you have to pay to play just to be able to make a connection. How does one know if and when to utilize those arenas just to be able to make and develop those relationships? I think that's a good question. And there's also a related question of finders, right? There are just a ton of people out here promising startups to connect them to capital in exchange for stock in the company. And unless they're a registered broker dealer, it's probably pretty unlikely that finder is going to be able to do that legally. By legal, I mean in compliance with securities laws, so that the company wouldn't have to potentially give that money back to the investor, which could be disastrous. So that was not your exact question. Yours was more on these angel pay to play groups. I think you got to do your homework on those groups, and that includes maybe talking to some companies that have gone through there, and also seeing kind of who's gotten placed through, what is Crunchbase and PitchBook and other folks they sort of say about the sort of investors that are playing in that space in terms of them actually closing deals and investing money. I don't have a whole lot of experience with those VC and angel groups where it's pay to play, but I certainly would be thinking about those things. Again, not legal advice, general information. What requires a legal opinion? So a legal opinion is usually in this context, investors may request a legal opinion. That is, they may request that the company's counsel review something, whether it's the IP, on the patent, or more likely, especially for an early stage company, the capitalization of the company, that is who owns what stock, and opine that all the stock has been duly authorized, validly issued, fully paid, and non-assessable. And so that involves legal counsel, your own legal counsel, combing through your books to do that, because that provides the investor with insurance, that assurance, not insurance, assurance that nobody else has a claim for stock in the company or claim equity interest in the company. Yeah. How does a startup pull together a team of people to work without pay until they have a product ready for market? So, you know, the reality of it is that a lot of startups don't comply with employment law. Employment law is set both at the federal level and then at each individual state level. That is here in the States, right? And then also sometimes even at the local municipality level. So let's take, for example, one of the common ones is wage and hour issues. That is that the employees are paid a minimum wage and overtime if they, if they work overtime, a certain number of hours, and they take meal and rest breaks and those types of things. Many times that's not complied with, unfortunately. Sometimes what companies do, what startups try to do is, even though people aren't necessarily going to get paid what their ordinarily full value is, right? So they're going to get equity, but rather than just kind of blow through those minimum wage laws, companies will pay sort of minimum wage for that work to try and navigate that. But it is a challenge, and it's, sort of, I think the risk is less worrisome if it's at small scale, right? It's just two founders and they've known each other kind of forever. It's different if you're doing that at scale, you got 20, 30, 40 people. As an early stage company, who should be on the board and how do we pay for D&O insurance? Well, usually there are going to be a couple of founders on the board initially. I think that that's probably the right answer. You want to be thoughtful about who else comes on the board and the size of the board, because again, sort of easier to put somebody on than it is to remove them. Sort of same guidance as it comes to to officers, right? You don't want to necessarily make everybody the chief of everything, because one day you may need to hire somebody, who has been working for 20 years as the chief operating officer at a well-established company. And if there's no room for them, there's no title, what are you going to give them? And it's hard to remove titles from people. They don't like it. Is 1x liquidation preference more common or 2 or 3 more common? I would say probably 1x in decent deals these days that I'm seeing. How about the issue of ethnic diversity for socially disadvantaged startups with interest in accessing capital through investor relations? What is being done to bridge the white advantage wealth gap? Are we seeing a positive change in the corporate climate surrounding this major topic? I do think that in the last, especially in the last couple of years, and it seems to be coming, further and further along, that that is a measurement. Diversity, equity, and inclusion is a measurement that VCs are looking at and making their investments. And then there certainly are more and more investor bases that are focused on trying to bridge that equity, that disadvantage gap, you might say, or disadvantage, you might say. So I do think that is getting better. I'm not saying that it's where it needs to be. I think certainly, and this is just sort of going off the top of my head, in the pandemic, it seemed, some of the initial reports seemed to indicate that startups founded by women were receiving less capital than they had been historically. I don't know whether or not that's been sort of corrected or what the latest figures were, but that's kind of what I remember reading around October or so. During Bootstrap, what is the healthy and acceptable debt to equity ratio for most VCs to invest in? Some VCs don't want to invest just to pay off debt. I think that's right. So when a VC and most investors make an investment, they're really investing in the future of the company. They want their dollars to be applied towards the future of the company, not paying off debt in the past. So I think if you can make a business case as to what the right equity ratio, debt to equity ratio is in your particular business and how you're not going to be overwhelmed by debt, that's what you need to do. Oh, great question. If you are past pre-revenue, have customers and sales volume, why would an entrepreneur agree to vesting? They already own their shares and have created value. Again, when an investor makes an investment, it's not about what you've done in the past, it's about what you're going to do tomorrow to increase the value of their investment. So a founder, to get the money in from that investor, may need to subject or resubject that founder's shares to vesting. Now, doesn't mean all of the shares are going to be subject to vesting, right? Instead of, restarting over 4 years, 1 year cliff, maybe 25% or 50% are already vested. But the answer is to get that money in the door. That's why you might need to resubject your shares to vesting. Would you mind providing some comments on the risks around CFIUS approval and the trends of foreign investors investing in the United States? So let's zoom out. CFIUS is an acronym, CFIUS, the Committee on Foreign Investment in the United States. Kind of around 2018, the fall of 2018, there was a huge, it used to only really apply in situations where a foreign person, and that, again, persons being used broadly, not just an individual, but could be an entity, was taking control over, U.S. businesses, especially with respect to certain areas, right, in terms of areas of interest for national security purposes. That changed or expanded is maybe a better way to put it in the fall of 2018. There's a lot of uncertainty until I think the regs got finalized in January of 2020. I am not a CFIUS expert, but I work with CFIUS experts. So, whenever we have a foreign person investing in a startup, we look, we at least take a look at to figure out, oh, do we need to do a deeper layer of CFIUS related analysis? And what I mean by that is taking a look at, how much is this person putting in? Are they going to have access to sensitive information? Is that startup like in a space that, CFIUS is scrutinizing? So it's not just about startups that would make weapons technology, but things that may have that application, like AI, for example. Startups that have sensitive personal information that could be used against U.S. citizens. So you may recall, CFIUS made the Grindr deal get unwound, I believe, right? So it is becoming a hotter and hotter area, one that startup founders, I don't think, are keyed into enough yet, one that we certainly are. And then in terms of CFIUS approval, and I would defer to my CFIUS expert on that. I know that we've had to have them go through the process, but I don't spearhead that because that's a highly specialized area. Let me go back up here. Is there a temptation to raise more than you have to while the money is relatively cheap and accessible right now? Yes, I think so. One issue of sort of raising more than you have to is that maybe that means your valuation wasn't high enough. you could have raised a little bit less, but it got a better valuation, in which case you wouldn't have gotten as much dilution. I think that's something to sort of balance. But by and large, what you should be thinking about when you're doing a raise, right, is raising enough money to get to the next sort of inflection point when you'll need to raise more capital, and then having some cushion in there. And understanding that, yes, there's a business cycle in this. And it does ebb and flow. So you will probably want to raise a bit more than you think you need, just so you have extra money in the bank. To what extent are benefit corporations and benefit LLC structures disadvantageous? So for a while, we never saw any B Corps, but it's becoming more and more popular, and those deals are getting done. Anecdotally, it sort of seems like most of the true B Corps are kind of on the consumer facing end, because it resonates. If you're building a consumer focused brand, it resonates particularly well, as opposed to just like a B2B company. Any tax correct considerations for a correct structure? Again, usually a Delaware C Corp, if you're going to be a true, not true. If you're going to be, your typical venture-backed startup, we explain why Delaware, we explain why C Corp. Not a lot of tax planning, at least at that point. Thoughts on new crowdfunding finance models? So I actually don't play in the crowdfunding space. There are VCs who will invest in crowdfunded companies, but it's actually, it sounds like it would be like those two things would go very well together, but historically they have not, and they have not for a couple of reasons. Historically, you couldn't raise more than $1 million for crowdfunded companies. I understand that's now been increased to $5 million or so. And then some of the other reasons are having just a ton of people on your cap table, especially unaccredited investors. VCs will many times stay away from that. That's different than if you're using like a, I can never read them, like a Kickstarter campaign or something along those lines. I'm sorry, I think I'm losing my voice. I'm going to take a drink of water. If I make a cap table before investment, I'm not sure I'm following that question. If you do a pro forma cap table, it's about trying to understand what the cap table is going to look like at a moment in time. And what I keep talking about is after that series, that price round closes. And so, it's maybe when you first start off, it's just going to be you as the sole founder, or you and your co-founder. But the Series A, you're going to have you, your co-founder, maybe some initial early employees. You gave them some they purchased restricted stock at a very low dollar number. You're going to have a equity incentive plan on there. And you're going to have the preferred stock. So, it wouldn't be unusual if, you're on a fully diluted basis, you and your co-founder were down to 60, 55%, 50, or maybe even under. And you should know that ahead of time. Referrals is a good way to knock down the door of VCs. Do you have any recommendations for knowing more VCs? Is joining programs a good way to start? Like an incubator program? Yeah, it seems like, I don't remember when exactly Y Combinator started, 2009, 2011. I don't know. They seem to have sort of been one of the first, and it has just proliferated. It sort of depends on the incubator or accelerator, but that is potentially, an incubator in your space, in your geography, is something you should certainly consider. Whether or not it's the right one, you got to do some research, maybe talk to some cohort, like a cohort that went through before. At what round can the entrepreneur take some money off the table? It just sort of depends on how well the company is doing and whether or not there's the demand for it. So, I mean, it could be pretty early, but again, it's you got to make a business case for it, just like anything else. So, you know, if you can demonstrate, for example, you have bootstraps and you are kind of overly strung out and been living on ramen for 5 years, and the company, because of that sacrifice, the company is very profitable and is just, you know, blowing the doors off of things, then you probably make a business case for it. You know, it's not going to be some sort of probably extravagant amount that you're going to be able to extract, but you'll probably be able to take some money off the table. How many is too many on a board, and do VC board members get compensated like you compensate outside board members? So VCs on boards usually don't get the sort of compensated in terms of stock. In terms of typical outside compensation for board members, I mean, it just sort of depends. Many times they've already got a hook in the company. So, you know, I need to see that situation before I could actually kind of substantively answer that. In terms of how many on the board, I mean, usually at the Series C or Series A, it's kind of board of 3. Many times 2 founders and a VC, not always. Again, you got to remember there's going to be another round, there's going to be another round, right? And so, you know, you don't necessarily, even though you may end up ultimately with a board of 7, you don't want to start out there, because then people are going to need to swap in and out, and that could be a sticking point and you might not be able to get a deal done. Although the conversion mechanism looks the same, a SAFE is not debt structure, while convertible note is. The SAFE does not have a maturity date. That's correct. How is IP treated in a liquidation? Can the patent inventor regain control somehow? So you would need to talk to bankruptcy counsel about that. You know, I think the answer is probably you probably need to pay some sort of compensation or consideration for that. Are you seeing more US-based VCs investing in Asia based on startups? I am. I will tell you that I am also, for my own personal practice, I'm probably about 80% company side at the moment, 20% VC side. So, you know, I have a bias towards seeing what VCs are doing as they make investments into companies. Hold on one second. Okay. For startups not qualifying for VC funding, would bonds work? So again, you know, I have sort of a limited, not limited. I work from time to time with any number of businesses outside the VC space. But kind of once you get out of that space, there are lots of different models. So, you know, I can't answer that question because there's kind of too broad a potential answer. I'd have to have a lot more information. As we approach VCs for investment, what are some not so good qualities of a VC or a group to be mindful of? What are red flag situations or term proposals on their end that would make it wise to consider walking away from? Again, the VC relationship is going to be hopefully is going to be a long-term profitable relationship for the both of you. So I think you got to build trust and rapport. You got to check your gut, or you got to test your gut on some of these issues, or go with your gut. You got to take a look at those terms that they give you and line up against kind of what's out there in the market. Additionally, you can do Google. You can do other sorts of things to see, have these VCs been in disputes with their portfolio companies. You can talk to some, you can ask for them to make an introduction to some of the companies that are or have been in their portfolio. You can also figure out who was in their portfolio by figuring out who they invested in by looking at PitchBook, Crunchbase, blah, 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 Google. And you can have some conversations to figure out, yes, these guys and gals were there with us through the thick and thin, or I'd rather kind of not talk about it. Lots of times if people don't have something nice to say, they don't say anything. Speaking from a company located in the Midwest, do VCs care where your company is located, or they really like to invest locally? So there was this trope sort of historically saying that I think VCs didn't want to invest, in a company that took them longer than 30 minutes or an hour to drive to from their office. I think that's changed in the pandemic. I think the VCs are much more open and interested in building relationships and investing all across the US and all across the world as well. We're seeing a lot of that. And, that's because we now feel comfortable, they now feel comfortable sourcing and building relationships online. So no, I think it's moved away from only being local. What are some additional, this is a great question. What are some additional measures to put in the front? What are some additional measures to put in place on the front end that would help prevent losing control of the company as founders? I think the best thing you can do as a founder is work with counsel and get a set of advisors that are experienced with venture-backed startups and help you navigate the process. Companies typically ask, and founders ask, can we do stuff on the front end to help insulate us and have us keep control? And one of the real issues here is you can get all of those things in place, but in order for an investor to put their money in, they're going to make you strip them out. So many times trying to do that on the front end is a waste of effort. What's probably better spent is running those pro forma cap table models, understanding how much liquidity you're going to have at this round, at the next round based on some assumptions, at the next round based on some assumptions, and sticking to your guns in the negotiation and being willing to walk. That's a key aspect of it. All right, so we are coming up on the end. And I think we've hit the end mark. So I'm going to say thank you very much to my audience today for attending. If you didn't catch all of it, we'll send it to you so long as you've registered. I want to thank Jennifer Stowell for introducing me at the beginning of today's program. And I want to thank Idea to IPO. I'm Jason Putnam Gordon. I'm a venture capital and emerging growth company attorney at Polsinelli. If you'd like to have a conversation, I keep office hours. Again, happy to give some general information. Reach out to me on LinkedIn or send me an email. Thank you very much. Have a great night. And I'll let you get back to building your great company. Take care.